Now, as an economist, we are paid to figure out, well, what could trigger a recession? And there's basically 5 things us economists are tracking right now that could lead to a recession. Number 1 would just be a big spike in energy prices. Think if there's a war in the Middle East, say, for example, and oil prices went from the $80, $90 today to say $160 to $200 for a barrel of oil. Well, that could trigger a recession. So higher energy prices, number 1. Number 2 would be the Federal Reserve keeping those short-term Fed funds interest rates too high for too long, keeping the inverted yield curve. I was just reading the other day that this is the longest that the yield curve has been inverted, basically meaning short-term interest rates above long-term interest rates in basically the history of the United States. It's been over 2 years now, and normally we would see a recession. So we are worried of the Fed keeping interest rates too high for too long, which could trigger an economic slowdown. So that's short-term interest rates. Number 3 on our top 5 list of what could trigger a recession would be higher long-term interest rates. Say, for example, the 10-year Treasury bond. Right now, we're running close to about a $2 trillion deficit in this country. Well, what if the buyers of those bonds start to pull back? Foreigners, banks, insurance companies, whatever. What if our appetite for U.S. Treasury bonds begins to wane? Those interest rates will then begin to rise, and that could slow down the housing market, business investment spending, and could trigger a recession. So that's number 3 on our list. What about number 4? Well, what if we saw a drop in the price of homes, stock price drop, or even commercial real estate property prices really drop? That would create what's called a negative wealth effect in this country, where you and me become less wealthy, and that curtails our spending. So we're looking at prices of these assets. Once again, real estate, stocks, and commercial real estate prices. And then number 5 on our list are more bank failures. Similar to what we had back in 2008, 2009, when we had the Great Recession, we had close to 400 banks failing within a couple of years there. So if we had more bank failures, that could lead to another recession.